Hello and welcome to Investment Insight. Before we begin, make sure to subscribe and hit the like button. Now let's break down what's happening in the market today in a clear and simple way. So, imagine you just logged into your brokerage account after, a pretty brutal week in the stock market.
Yeah, a lot of red on the screen lately.
Right, exactly. Your tech holdings are bleeding, so you instinctively check your safe haven, right? Your gold.
You're expecting it to be that one patch of green.
Exactly. But instead, it's dropping right alongside all your riskiest assets.
Hmm.
And that's the exact whiplash that investors are feeling right now. Gold prices have taken this really dramatic, highly publicized plunge.
It is, it's a really disorienting moment for anyone with a traditional portfolio. I mean, when an asset that is historically defined by its stability suddenly starts acting like a volatile tech stock, it forces you to completely reevaluate what's going on.
Yeah, and to do that, we need to separate the actual data from the sensationalized headlines. Because looking at the recent analysis, some of these headlines are screaming about a collapse from, like, $5,600.
Which is, frankly, just a bit exaggerated.
Right. When we look at the actual COMEX futures data, the true peak was back in late January 2026, and it hit around $5,318.
Yeah, that was the real top.
And now, fast forward to late June, we're looking at levels around $3,973. So if you do the math, that's roughly a 20% correction.
Exactly. I mean, it's a massive recalibration, absolutely. But calling it an apocalyptic crash is, well, it just ignores the broader context.
Which brings us to the mission for today's deep dive.
Hmm.
If you're sitting there wondering if the gold rush is permanently over, we're going to unpack exactly why gold is dropping.
There's a lot going on under the hood.
Oh, for sure. We're going to explore how everything from the Federal Reserve to the Middle East is playing a role, and most importantly, what this means for your everyday portfolio.
And, the logical starting point for this is always the Federal Reserve. If you want to understand why gold is losing its shine, you have to start with the entity that controls the value of money itself.
Right, and there's been a big change there recently. According to the research data, Kevin Warsh took over as the 17th Fed chair back in May 2026.
Yeah, and his first major test was that mid-June FOMC meeting.
Which everyone was watching super closely.
Oh, absolutely. And during that meeting, the Fed opted to keep rates frozen at 3.50 to 3.75%.
But the freeze wasn't actually the big news, right?
No. Crucially, it was their forward guidance. Because inflation is still stubbornly high, they basically kept the door wide open for another rate hike, possibly as early as September.
Okay, let's unpack this for a second. Let's use an analogy to make this super relatable. Gold is essentially just a very beautiful, very heavy brick.
That's one way to put it, yeah.
I mean, it sits in a vault, right?
Yeah.
It doesn't pay you a monthly dividend or interest like a high-yield savings account does.
Exactly. And that brings us to the concept of opportunity costs and real interest rates.
How does that actually work for, like, an everyday investor?
Well, when the Fed keeps interest rates high, and specifically when the real return on government bonds goes up, the quote-unquote cost of holding a zero-interest asset like gold just becomes way too high.
Because you could be making guaranteed money somewhere else.
Precisely. Gold isn't just competing with other metals, it's actively competing with cash and bonds. Capital goes where it's treated best.
Right, so sitting on a shiny brick that yields nothing is a tough sell when treasuries are paying out.
Yeah, exactly.
But it's not just that bonds are paying out more. The currency used to buy gold, the US dollar, has also become a massive roadblock here.
Oh, a huge roadblock.
According to the data, the US dollar hit a one-year high in late June 2026.
Which is a huge deal for international demand.
Let me break this down simply. If you live in Europe or Asia, gold is still priced in US dollars. So if the dollar gets super strong, buying that exact same ounce of gold suddenly costs way more in your local currency.
It acts like a direct tax.
Yeah, it's like trying to buy a concert ticket, but the ticketing fee just tripled out of nowhere. You're getting the same ticket, but it hurts your wallet a lot more.
That's a great way to think about it, and that naturally just crushes global physical demand. But we also have to look at what else is driving things right now beyond just interest rates and the dollar.
Right, there's the geopolitical side.
Exactly. We had the recent U.S.-Iran peace agreement, which was a massive geopolitical shift.
And according to the recent analysis, that led to a pretty immediate drop in oil prices.
Yeah, it eased those immediate inflation fears. But what's fascinating here is how gold functions in these scenarios. Gold basically acts as the global financial panic room.
The panic room, I like that.
Yeah, think about it. When war breaks out or oil supplies are threatened, investors get scared. They run into the panic room and lock the door.
Because they want safety at any cost.
Right. But with the Middle East tensions easing, investors basically feel safe enough to step outside again.
So they don't need the panic room anymore.
Exactly. And that just drained the entire geopolitical premium right out of gold's price.
Wow. Okay, so higher rates and global peace are driving prices down. But who is actually hitting the sell button so aggressively? Because this drop was fast.
Yeah, the data's really telling here. By May 2026, global gold ETF inflows basically just flatlined,
The buying just stopped.
just completely evaporated. And then the real trigger happened on June 5th when gold fell below its 200-day moving average.
Okay, wait, here's where it gets really interesting to me. Because according to recent analysis, people might be selling gold to cover their losses in tech stocks.
Yeah, cross-asset contagion.
But wait a minute. I thought gold was the ultimate safe haven. Why would you sell your umbrella while it's raining in the stock market? That makes no sense.
I know, it feels totally backward. But you have to realize that earlier this year, gold became this incredibly crowded FOMO trade. Fear of missing out.
Oh, because it was going up so fast.
Right. When it crossed $5,000 earlier in the year, it stopped being a quiet, boring hedge. It became a highly priced momentum asset everyone wanted in.
So you had aggressive tech investors who were also piling into gold just because the chart looked good.
Exactly. And when those same investors start facing margin calls because their tech stocks are tanking.
Oh, the broker comes knocking.
Yeah, the broker wants cash right now. And when you need quick cash, you sell whatever you can easily liquidate. And for a lot of people, that included their highly profitable gold ETFs.
So it wasn't that they hated gold, it's just that it was the easiest thing to sell to bail out the rest of their sinking ship.
Exactly. It became a highly liquid APM machine.
That is wild.
Yeah.
So if gold is being sold off like a risky tech stock, does that mean its reputation as a safe investment is just completely destroyed?
I mean, it's easy to feel that way when you look at the chart, but no.
Right, because looking at the data, the long-term drivers for gold really haven't disappeared at all.
Not even close. I mean, central banks in emerging markets are still buying it. They want to diversify away from the dollar.
And inflation isn't magically back down to 2% either.
Right. And you also have these massive, sustained U.S. fiscal deficits. Under the current Trump administration, that fiscal deficit environment is continuing, which means the core fundamental case for gold remains completely intact.
Okay, so what does this all mean for you, the listener? Let's bring this back to the homeowner's insurance analogy.
I think that's the perfect way to frame it.
Think of gold like homeowner's insurance. You absolutely need it to protect your portfolio. But earlier this year, at $5,000 an ounce, you were basically paying $10,000 a month for that insurance premium.
It was just way too expensive.
Exactly. So this recent drop to $4,000 isn't the insurance company going bankrupt. It's just the premium coming back down to a normal, rational price.
That's spot on. So from an actionable standpoint, the takeaway here is don't panic sell everything just because it's dropping.
Right.
But at the same time, don't blindly buy the dip expecting it to rocket back to 5,000 tomorrow.
So what should people do?
You need to treat gold as just one part of a broader defense basket. You should also be looking at treasuries, maybe TIPS, treasury, inflation-protected securities, and depending on your timeline, maybe even Bitcoin or defense stocks.
Diversify your defense, basically.
Exactly. And there is one crucial warning I have to give here. Do not assume that buying gold mining stocks is the same thing as holding physical gold.
Oh, this is such a good point. Why is that so dangerous?
Because physical gold just sits in a vault. But a mining company, that's a living, breathing business. They have to deal with real-world problems like surging wages, diesel fuel costs, labor unions.
Right. Physical gold doesn't go on strike.
Exactly. If energy costs skyrocket, a mining company's profit margins can completely collapse, even if the price of gold is actually going up.
Wow. So you're basically taking on standard stock market risk, not safe haven protection.
100%. You have to treat mining stocks as risky equities, not as a substitute for your panic room.
So to wrap all this up, the big takeaway here is that gold hasn't lost its status as a safe haven. What we are seeing is just the market experiencing a normalization of a wildly overpriced insurance premium.
Yeah, the panic has subsided, so the price of safety has come down.
Before we go, I know you always have a larger macro question to leave us with. What's the provocative thought for today?
Well, I want everyone to ponder this. We've talked about how gold's current weakness is tied so heavily to the strength of the US dollar and these high interest rates, right?
Right.
But what happens to your portfolio's panic room if the weight of the massive US national debt suddenly makes that strong dollar start to crack?
Oh, wow. If the dollar gives way, the whole equation flips. That is a heavy thought to leave off on. Don't forget to subscribe and hit that like button.